Anisha, you have the management of Zee with you. It's right now the top gainer.
Yes, Zee Entertainment came out with a strong set of fourth quarter earnings, and they have guided for a strong FY18. They see the demonetization impact over, and the biggest comfort is that they still see their margins ahead of 30%, upwards of 30%. Brokerages remain pretty positive on this company, and across the board, we have seen them increase their target prices for Zee. So this is one stock that is doing well. I did get a chance to speak with Mihir Modi, Chief Finance and Strategy Officer at Zee Entertainment, and I began by asking him about the advertising revenue growth that they saw in the fourth quarter, around 8%. So I asked him whether we can say that the entire demonetization impact, is it over now?
While the fourth quarter did have some impact of demonetization, I think without it, we would have expected the growth to be even better than that. I would say at least about double digits. But demonetization still had some impact in Q4. But as I see, the recent months and the next few months as we go ahead, it seems that the demonetization impact has disappeared, and the market advertising spends are back to the growth levels that were seen before the demonetization impact. So I see that the full year FY18 will grow in low double digits for the market, and we would certainly attempt to beat that market growth for Zee Entertainment.
Can you talk to us about the segments which saw strong ad spending?
So luckily for us, there's no one particular sector that has picked up and which is not jumped off the sheet from its contribution to growth. But mind you, for the fourth quarter, the industry ad spends were flattish to negative, and therefore, for us, the growth came from sectors across. But that was different from the market growth, like I said, which was negative. So, for example, FMCG for the market degrew a little bit, whereas for us, it gave us some growth. So our growth has come across sectors and not any one particular sector.
Right. Subscription revenue decreased 6% in the fourth quarter, mainly on the account of the sale of the sports business. When do you think you will revert to trend growth when it comes to subscriptions? What growth can we see here in subscriptions in FY18?
So let me dig a little deeper into the 6% degrowth in the subscription line item. So first things first, subscription revenues cannot be seen or should not be seen on an isolated quarter basis, because the nature of that revenue is such that one or the other quarter does have catch-up revenues, and therefore it's not a smooth trend and it is very, very lumpy. Now in that context, we had a lot of catch-up revenue in Q4 of last year. Both domestically and internationally. So internationally, we had a big deal with Dish Network in the US, which got renewed last year, fourth quarter, and therefore there was a catch-up revenue sitting in that quarter internationally. And similarly, domestically, we finalized a lot of our agreements in Q4 last year, and therefore that quarter was high on domestic subscription revenues as well. Now compare that with this year. Most of our catch-up came in Q2 and Q3 of this year, and therefore Q4 on a base effect basis seemed much smaller on the domestic side, and obviously on the international side also we didn't have the Dish Network kind of a lumpy deal, and therefore that also was normalized. And therefore the degrowth. Sports did have some impact in that as well. But the lumpiness was the bigger reason for the Q4 degrowth. If I look at the full year subscription revenue, it grew at 10%, despite sports getting out of it. So that's the point I was making, that on a full year basis, subscription revenue grew 10%, and that obviously takes care of all the lumpiness that you see on a quarter to quarter basis. I would add one more point here, is that while the blended growth is 10%, the domestic subscription growth for Zee has been just under 12%. And that's another point that shows the healthiness of our subscription revenue growth. I will go one step further, and from that domestic subscription revenue growth of 12%, mind you, sports is still factored in this. So if I take out the whole sports business and look at it like to like, the actually domestic subscription revenue full year, non-sports, is about 13.7%. And that gives you a context of how our subscription business is doing because of these elements that are sitting in the quarter numbers.
Now, the international business faltered slightly when compared to the year-ago period. Is this a one-off, or are there any structural challenges that you're facing?
So we had some regulatory issues in some markets, and then there was some economy market risk in a couple of markets. For example, the Middle East, the economy has not been doing well, and that showed up in part of our numbers for this quarter. Similarly, Bangladesh has a regulatory issue. So in Bangladesh, the regulation came in which required non-national or non-Bangladeshi advertisers being unable to advertise in that country on our channel. So we lost some ad revenue there as well. Nigeria had another small issue on the regulation. But 2 points I'll make here. One is, the expanse of geographic spread that we have. Some small, kind of aberrations or issues will keep popping up once in a while. But we are very diversified in our international presence, and therefore it's not a very big risk. Secondly, even in some of these cases, we are working in some cases with the government, like in Bangladesh, to represent to them the benefits that channels like us bring, and therefore consider reversing what they have brought in. Similarly, in Nigeria, we are working with the government to make sure that some of the foreign exchange regulation issues that they had are resolved. So overall, I don't see this as a structural issue. I mean, some government regulation here and there, and the economy reviving in some other parts of the world where we have a problem should take care of it.
Now, you've announced your a la carte pricing, which is slightly lower than most of your rivals. Is this an attempt to get more subscribers? Will it help you generate better volume growth going ahead?
So our attempt through our pricing is to make sure that while our viewers get a wholesome package at a reasonable price, we certainly competitively should be able to get as maximum subscribers as possible. And these are the 2 or 3 factors that has gone into building our pricing for the under the new TRAI regulation. So indeed, the answer is yes, and a few other things as well.
Your margins at 30.7% are also ahead of estimates. You really tightened the belt when it came to cost, be it operational cost or finance cost, both were down. Is this the best it gets as far as margins are concerned? Can you maintain this?
So what we've said all along is that on a full year basis, our margins should be north of 30%, and that should be the attempt. I think we will continue to bring our margins and keep our margins north of 30%. I think some quarters, because of investments that we may have to do or we may choose to do, the margins may dip here and there, but our attempt will be to keep them north of 30%. I think I should also say that theoretically it's possible to take the margins further up beyond the hygiene 30%, probably 200-300 bips above that as well. But we want to make sure that we also continue to invest in the future so that these margins are sustainable, and that will be the attempt.
Is the competition from digital players now starting to pinch? Are you looking at increasing spending on content?
I think I would answer this with a broader answer first and then come down to the specific question you asked. I think digital indeed is something that cannot be ignored. We have our own play in it. We are working on a much more detailed strategy to apply over the next 18 to 24 months for our digital businesses. Having said that, it is still not become a huge threat to television. It is more next gen, and therefore one should not ignore it, and we are not ignoring it. To answer your question, indeed digital first content will be a part of our thinking, and also leveraging our existing content that we make for the linear medium on digital platforms is also going to be an integral part of the digital thinking for any player, I would think, currently in India. And I don't see any problem in that panning out, any differently, I would say.
Zee looking for newer acquisitions. Are you looking to buy 9X Media?
So speculation is speculation, and we as a media business, we are a small industry. You are also part of it. So these kind of conversations and speculations do continue. I think whenever we have anything to announce formally, we will do that.
The final judgment of the TRAI tariff order is awaited on June 12th. What are your expectations from this judgment?
I think it is indeed a variable. It is a moving part with regulation, with the courts, and then the competitive actions involved. I think the way we have filed, well structured, and then filed our pricing, we believe that we are set up well to address whatever changes come about. But given the volatility, it's really difficult to comment on what may happen. But all I will say is we are very well geared up to react in a very swift manner to whatever changes come about, and our current filing is robust enough to take care of what we believe is going to unfold now.
And lastly, what is the FY18 revenue growth target that you're working with?
I think ad revenue, I mentioned we would want to beat market on the ad revenue side. On the subscription side, we'd want to maintain the momentum that has been going on over the last few years on the domestic subscription side, which is a larger piece for us. But subject to a caveat of how the regulatory/judicial events unfold. But overall, I think we're very confident that we will react to the situation and maintain a healthy growth, hopefully a market-beating growth again.
So that was the management of Zee Entertainment talking about the fourth quarter earnings, the impact, demonetization, and what they're looking ahead when it comes to advertising and subscription growth.